Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered. Welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah, and we are here to talk about what's going on in the world of finance, stock market, etc., on this Thursday, April 9th. If you celebrate as a Christian, today is Maundy Thursday. If you celebrate as a Jew, today was Passover. So lots going on this week. And of course, we're all, or I guess I shouldn't say all, shouldn't use absolutes, but many of us are still isolating and trying to flatten that curve. So, and COVID-19 is still affecting the economy. Let's talk about how and why and what it's doing and what's going on. Here's what happened to the stock market today, Thursday, April 9th, 2020. The Dow Jones Industrial jumped 285 points. It rallied 285 points or 1.22%. The S&P 500 advanced 1.45%. The NASDAQ Composite gained 0.77%, and stocks rallied to end a historic week of gains after the Fed unveiled even more measures to help the economy during the coronavirus outbreak. The Fed announced as a slew of new programs, including loans geared towards small and medium-sized businesses that will total up to $2.3 trillion. The central bank also gave more details on its plans to buy investment-grade and junk bonds. Those moves were enough to overshadow another massive spike in weekly jobless claims. JP Chase was among the best-performing Dow stocks, rising 8.97%. Shares of Amazon, Netflix, and Alphabet all closed slightly lower. The corporate earnings season is set to begin next week, with JP Chase and Wells Fargo among the companies reporting on Tuesday. Markets will be closed on Friday, tomorrow, for the Good Friday holiday. It is Easter weekend, so nothing going on in the market tomorrow for Good Friday. Federal Reserve Chairman Jerome Powell, took me a minute to get all of that out. Let me say it again. Federal Reserve Chairman Jerome Powell says the economic recovery can be robust after the coronavirus is contained. He said today that the economic rebound following the coronavirus-induced shutdown can be robust despite the sharp downturn. In the meantime, he said the central bank is committed to doing whatever it can to support the flow of cash to businesses and households, both through a plethora of financing programs and by keeping interest rates anchored near zero. Kudos on the use of the word plethora in this article. Powell spoke during a webinar for the Brookings Institution this morning that the Fed announced that new $2.3 trillion financing initiative directed at small and larger businesses, as well as households and state and local governments. He's quoted as saying, "At the Fed, we are doing all we can to help shepherd the economy through this difficult time. When the spread of the virus is under control, businesses will reopen and people will come back to work. There's every reason to believe that the economic rebound, when it comes, can be robust." He later added that it was impossible to put a firm timetable on when the U.S. might turn the corner. He said, "When the virus does run its course and it's safe to go back to work and it's safe for businesses to open, then we would expect there to be a fairly quick rebound. I think most people expect that to happen in the second half of this year after the second quarter. To try to be precise about where that will be, I don't think that would be appropriate." As for the Fed's efforts, he said central bank officials won't be in a hurry to curtail any of liquidity and lending programs or the move to near zero for short-term benchmark interest rates. When it comes time to wind down the programs, he said the Fed will do so, quote, gradually and predictably, end quote, and said it would be in no hurry to stop its open-ended asset purchases. The economy received more bad news this morning as weekly jobless claims hit 6.6 million, just a shade below last week's record high. Nevertheless, Powell pointed out that the economy has been strong before prevention efforts aimed at halting the coronavirus spread put a large share of the U.S. productive capacity offline. He said, we entered this turbulent period on a strong economic footing, and that should help support the recovery. In the meantime, we are using our tools to help build a bridge from the solid economic foundation on which we entered this crisis to a position of regained economic strength on the other side. But he added that while the Fed has worked to provide loans, Congress likely will have to provide direct cash injections to those areas of the economy that need it. He also reiterated the Fed's pledge to keep borrowing costs low as the efforts to stabilize the economy and subdue the virus continue. He said, we have also committed to keeping rates at this low level until we are confident that the economy has weathered the storm and is on track to achieve our maximum employment and price stability goals. That story was from CNBC. Over on Yahoo Finance, Gary Cohn says that restarting the economy after coronavirus is, quote, not going to be an overnight big bang. Testing for COVID-19 will be vital to restarting the $21 trillion plus U.S. economy, former National Economic Council Director Gary Cohn told Yahoo Finance, warning that the risk of ending the lockdown prematurely could easily come back to haunt the government. He said, I don't think we can go through a full-fledged reopening of our economy without testing. We would jeopardize ourselves going back into another full-fledged outbreak in the United States and then having to shut our economy down again. Cohn was one of the architects of the historic 2017 Tax Cuts and Jobs Acts, which over the last few years helped grease the wheels of record expansion until the coronavirus crisis brought the global economy crashing to a catastrophic halt. The former Goldman Sachs executive said that once the outbreak is under control, quote, the right answer is to start incrementally bringing people back to work in a very thoughtful process, end quote. Cohn has proposed a mix of tax breaks, incentives, and regulatory reforms for businesses to ignite economic growth after the COVID-19 crisis passes. Yet he warned that large businesses will have to consider dividing their workforce into teams to prevent a future outbreak of the coronavirus. For example, the A team comes in Monday morning, the B team comes in Monday afternoon, and then the C team comes in Tuesday, and the D team comes in Tuesday afternoon, he told Yahoo Finance's On the Move. Cohn says the key is to isolate the teams from each other so the Monday crowd and Tuesday crowd never cross, because if someone gets sick in the A and B crowd, we don't want them to contaminate the C and D crowd. The success of this strategy, however, depends on regular testing for COVID-19. He added, if we don't have testing when someone starts feeling ill and we don't know what group to isolate, we're going to end up having to isolate everyone again. The latest unemployment numbers indicate a challenge to bring millions of people back into the workforce anytime soon. The Department of Labor today, as I said, reported 6.6 million people filing for unemployment last week, bringing the total number displaced by the COVID-19 economic shutdown to more than 16 million people. Cohn suggested that putting them back to work will be a long process. He said this is not going to be an overnight big bang, underscoring how cities and states will have to approach restarting their economies differently. The mayors and the governors are going to play a crucial role in this. There will be certain cities and states that can open up much quicker than the other cities and states. Rural states with more open space will be able to open much faster than others because their population centers are less dense, he stated. That differs from, quote, states where you're highly densified, where you're dependent on public transportation, where you're dependent on elevators to get people in and out of buildings. Just as the unemployment figures were revealed, the Federal Reserve announced up to $2.3 trillion in expanded new and expanded and new historic lending facilities to support Main Street businesses struggling to survive. That's in addition to the more than $2 trillion Congress and the Treasury are allocating to navigate the economic storm. So a couple of different perspectives on how the economy is going to move forward as the coronavirus continues, or hopefully does not. So let's go ahead and take a break, and when we come back, we'll be moving on to a story about Disney. Stay tuned. You're listening to the GSMC Financial News Podcast, and I'll be right back. As we go into the break, I want to talk to you about Birch Gold Group. In 2008, as we were just mentioning, the U.S. national debt was $10 trillion. Today, it's over $23 trillion, and it's rising like a hockey stick. If you don't think we're sitting on a house of cards, you're living with your head in the sand. But since you're listening to this podcast, you are clearly intelligent and smarter maybe than the average American. So what is your plan? As one of the dealers of physical precious metals in the United States, Birch Gold Group helps Americans diversify their savings with gold and silver. Customers can purchase for physical possession or convert a portion of their IRA or 401k into an IRA backed by physical precious metals. Can you afford another hit to your retirement like the last downturn when the S&P dropped 50%? You can hedge against inflation and hedge against uncertainty and instability with precious metals. Gold is a safe haven against uncertainty. Thanks to a little-known IRS tax law, you can even now move your IRA and eligible 401k into an IRA backed by physical gold and silver. It's perfect for those who want to protect their hard-earned retirement savings from any future geopolitical uncertainty. If you look back historically, when the bottom falls out of everything, gold tends to safeguard savings. So if this is something that you are interested in pursuing, you can contact Birch Gold Group to request a free info kit on physical precious metals. See if diversifying into gold and silver makes sense for you. This comprehensive 20-page kit reveals how gold and silver can protect your savings and how you can legally move your IRA or 401k out of risky stocks and bonds and into a precious metals IRA. To get your no-cost, no-obligation kit, go to birchgold.com/finance. That's BIRCH gold.com/finance. Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about what happened in the stock market today and a couple of different perspectives on what it might look like as we work on getting the economy back in order after all of this finally comes to an end. Let's move on to a related story. I mean, it still has to do with COVID-19 and its effects on the economy. One of those effects, of course, is that with many of us staying home, working from home, isolating, and, well, just being home, is that streaming services are definitely picking up. I know we're watching a lot of different things that we might not normally have watched before all of this, and we've looked into some different streaming services. We even got my parents Disney Plus yesterday, which for them is pretty amazing because they don't really watch much TV, but there was a movie that my mom wanted to see, and so we got them hooked up with Disney Plus, and we had to do it over the Facebook portal because they are in Montana, and that was an interesting experiment to try to get them hooked up, but they seem to be doing well. In terms of streaming, Disney Plus surpassed 50 million paid subscribers globally, which is up more than 22 million since the last time Disney disclosed numbers 2 months ago. Disney's new subscriber numbers follow a series of rollouts in international territories, including the UK, India, Germany, Italy, Spain, Austria, and Switzerland. Although Disney Plus did delay the launch of its service in France due to government concern that it would put too much strain on bandwidth, the app is now available there too. Disney previously reported that it had 28 million subscribers during an earnings call with investors in February. To compare, Netflix has 167 million subscribers around the world, or just under 1/3 of Netflix's total subscriber base. Hulu, which is Disney's other streaming service, has 30 million subscribers. Hulu only operates in the United States, however, and Disney is looking at an international rollout beginning in 2021. We are truly humbled that Disney Plus is resonating with millions around the globe and believe this bodes well for our continued expansion throughout Western Europe and into Japan and all of Latin America later this year. Kevin Mayer, Disney's head of direct-to-consumer, said in a press release. He continued, "Great storytelling inspires and uplifts, and we are in the fortunate position of being able to deliver a vast array of great entertainment rooted in joy and optimism on Disney Plus." Disney Chief Financial Officer Christine McCarthy noted during the February investors call that Disney expects the majority of its growth going forward to come from international subscribers. The company is also expecting a bump in domestic subscribers around the premiere of highly anticipated series from Marvel and Lucasfilm. The Falcon and the Winter Soldier is set to premiere in August, with WandaVision in December. And The Mandalorian is returning for a second season in October. Cue the Baby Yoda memes. Disney Plus has also seen a swath of activity in the last few weeks. Frozen 2 and Onward were brought to the streamer early. Artemis Fowl, originally set to have a theatrical release, will now debut on Disney Plus as a streaming exclusive. Disney, like other studios, is looking at ways to pipeline certain releases as streaming exclusives now that people are social distancing at home and theaters remain closed due to the pandemic. Executive Chairman and former CEO Bob Iger told Barron's it's likely other titles will go to Disney Plus early, which makes sense since we cannot watch them in the theater. And that is actually the reason that my mom wanted it, because she and my dad and my brother own the movie theater in my hometown, and she was really looking forward to seeing the new movie Onward. They were set to have it, but then when schools closed down several weeks ago, they made the decision to shut down the theater as well. That was before the governor did the statewide mandate to stay home and close non-essential businesses. But she was really looking forward to it, and then she found out that it went to Disney Plus, and she was very bummed because she was wanting to see it. So Disney Plus now hanging out at my parents' house so my mom can watch Onward. I have not yet watched Onward or Frozen 2. I need to find time to watch both of them. I've actually been loving, I've been going old school, the original Parent Trap, for older school, and then in terms of newer old school, both of the Sister Act movies, both of the Three Men and a Baby movies. Yeah, just kind of reliving periods of my life. No, I was not alive when the first Parent Trap came out, so shush. But I have been enjoying it in the times that I take the time to sit down and watch TV in the midst of working from home, etc. Usually while I'm eating lunch is when I get my Disney Plus time in. In other media news, production has been shut down on a lot of Hollywood productions because of the coronavirus, and that has delayed the release of all films in theaters, which means millions of dollars lost in production cost and box office receipts. So now the big question that studios, large and small, are asking is, how much will insurance cover? Allianz, which is one of the main insurers for entertainment companies, estimates that Hollywood studios paid $400 million in premiums last year to cover unforeseeable events. Premiums are typically between 0.6% and 1% of a film's budget, which means they're spending as much as $2 million on insurance for a $200 million big budget picture. Now, studios are looking to collect. Alliance says it is seeing a growing influx in claims recently as studios have been forced to shut down major productions. All the major studios have halted production on big-budget films, Disney's Avatar sequels, Paramount's Mission Impossible 7, Universal's Jurassic World Dominion, and Warner Brothers' Matrix 4. But Alliance and other big film insurers, including Lloyd's of London, Chubb, and Aon, are now flooded and trying to figure out which claims they can deny. They've never had so many claims, which is, I think, what's unique about this situation, said Sarah Cronin, a partner at law firm Venable and an expert on entertainment industry insurance claims. She said this is the one thing affecting people all over the world, and insurance companies are getting tens and tens of thousands of claims at the same time. Studios are starting to get denial of coverage letters now, which means lots of litigation in the near future. I think what the insurance companies will say is we never intended to cover you for losses sustained because a pandemic occurred and people now couldn't go to theaters. That wasn't intended or covered, said Cronin. I think the studios would reply, we took out insurance in case we need to make a change that was unanticipated and there were substantial losses. It's all going to come down to what language is in each insurance policy. None of the insurance companies would comment on what percentage of claims they'll be covering. The CEO of the Insurance Information Institute, Sean Kevillahan, said in a statement, we understand that COVID-19 has not spared Hollywood films and TV show productions. The insurance industry provides policies that protect studios from unforeseen circumstances. Most of these policies are triggered when there are fires or accidents which either injure performers or damage property on set. Nonetheless, the coverages incorporated into the film and TV industry's insurance policies can vary greatly. Insurers will review every claim submitted to them to determine on a case-by-case basis when coverage is available. That could be a very interesting back and forth. I could keep going because that could keep going. Let's go ahead and take another break. When we come back, we'll be talking about bazookas. Yeah, we'll see. All right, stay tuned. You're listening to the GSMC Financial News Podcast, and I'll be right back. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast. We've been talking a lot about the economy and the effect of the coronavirus, and I think that's what we're going to be talking about for the unforeseeable future. I did want to end on a slightly lighter note, and that is a glossary of the Federal Reserve's full arsenal of bazookas. Yep. Okay. The novel coronavirus continues to grip businesses on main streets across the country, forcing America's employers to significantly pare back on their operations or shut down entirely. While Congress has passed a $2 trillion stimulus package to help businesses and workers, the Federal Reserve has committed to using its tools to, quote, support the flow of credit to households and businesses and thereby promote its maximum employment and price stability goals, end quote. Since the beginning of March, the Fed has swiftly slashed rates to zero, launched an aggressive quantitative easing program, and unleashed an alphabet soup of liquidity facilities to support the flow of credit in several markets. The central bank hopes its measures will ease credit conditions and keep businesses alive through the virus-induced disruptions. In total, Fed watchers have referred to the central bank's measures as bazookas, even going nuclear. The Fed is notably getting creative with its tools, dispelling any concern that the central bank was beholden to its 2008 playbook. For the first time, the Fed is tackling financing pressures in the municipal debt market through the MMLF, CPFF, and Municipal Liquidity Facility, and the corporate debt market through PMCCF, SMCCF, CPFF. Yeah, alphabet soup indeed. Here is a full breakdown of all of the tools announced by the Fed as it battles the economic impact of the coronavirus. Date announced March 3rd and March 15th, near zero interest rates. The technical details: interest rates are the primary tool for monetary policy. The Fed broadly steers rates to support lending when the economy is in need by lowering rates, and pulls back on lending when the economy may be running too hot. Next up is quantitative easing, or QE. The Fed said it will purchase at least $500 billion of U.S. Treasuries and $200 billion of agency mortgage-backed securities over coming months. On March 23rd, the Fed announced that it was suspending those limits and would buy assets in the amounts needed to support the economy, which would also now include agency commercial mortgage-backed securities. Through QE, the Fed is directly intervening as its own counterplay in the Treasury and agency MBS markets to absorb securities onto its balance sheets. Repurchase agreements, or repo. As the plumbing of the financial system, the repo market provides financing for banks and broker-dealers at the center of the economy, allowing the levered institutions to cover positions on their balance sheet by lending sums of cash to one another. Since last September, the New York Fed has offered repurchased agreements to alleviate pressures in the market for interbank short-term loans, but has since increased the scale of the repos available in the wake of the novel coronavirus. Even though the Fed is offering over $5 trillion in total repo agreements, as short as overnight and as long as 3 months, the uptake has not been anywhere close to that eye-popping figure. U.S. dollar swap lines. Companies around the world disrupted by the novel coronavirus are loading up on U.S. dollars to cover currency hedge positions. As a result, the Fed announced U.S. dollar swap lines with 5 other major central banks, including the European Central Bank and Bank of Japan, to ensure the availability of the world's reserve currency. On March 19th, the Fed expanded its U.S. dollar swap lines with 9 other central banks, and on March 20th, the Fed increased the frequency of its previously announced swaps with the 5 major central banks. Tapping into capital and liquidity buffers. After the 2008 financial crisis, Congress passed the Dodd-Frank Act and required banking regulators to increase the amount of capital and liquidity held at U.S. banks in case another crisis struck. To withstand fluctuations, most banks hold capital and liquidity buffers well above their statutory requirements. But the Fed on March 15th encouraged banks to tap into those buffers to lend out into the economy. The Fed also lowered reserve requirements to zero and on March 23rd tweaked a bank capital regulation to more loosely allow banks to lend out retained income. Discount window. The Fed can directly offer short-term loans to banks and lowered the interest rates on discount window loans to 0.25% as of March 16th. The Fed also joined other major banking regulators in explicitly encouraging banks to take advantage of the loans, which the 8 largest U.S. banks did that same day. Commercial Paper Funding Facility, CPFF. The Fed announced that it would directly finance eligible commercial paper, a common form of short-term corporate debt. Although the Fed does not have the ability to add commercial paper directly to its balance sheet, the central bank established a special purpose vehicle, SPV, with $10 billion of equity investment from the U.S. Treasury to buy high-rated 3-month commercial paper. On March 23rd, the Fed expanded the CPFF to include some short-term municipal bonds as well. Primary Dealer Credit Facility, PDCF. The PDCF offers short-term, up to 90-day loans to primary dealers or firms that serve as intermediaries between the government and the market. To get access to the loans, the dealers can offer up a wide variety of different types of collateral: investment-grade corporate debt, commercial paper, municipal debt, mortgage-backed securities, asset-backed securities, and even some stocks. Exchange-traded funds and mutual funds are not eligible collateral under the PDCF. Money Market Mutual Fund Liquidity Facility. Say that 10 times fast. Money Market Mutual Fund Liquidity Facility, MMLF. Much like the PDCF, the MMLF offers short-term loans, but to all U.S. banks. Under the program, banks offer up collateral in the form of U.S. Treasuries, asset-backed commercial paper, and some unsecured commercial paper. The MMLF is similar to the crisis-era asset-backed commercial paper Money Market Mutual Fund Liquidity Facility, AMLF. But the Fed on March 20th announced that it would expand the MMLF to take on short-term, with maturities of a year or less, municipal debt as eligible collateral as well. The Treasury will provide $10 billion of credit protection. Primary Market Corporate Credit Facility, PMCCF. For those of you who can actually rattle off these acronyms and know exactly what they mean, you are awesome. The PMCCF will purchase investment-grade corporate bonds with maturities of 4 years or less directly from eligible issuers and offer them a loan. Like the CPFF, the facility will have the support of billions of dollars from the U.S. Treasury and will hold the bonds in an SPV. Companies accessing the PMCCF would pay the Fed interest on the loan, but would be allowed to hold off on interest payments for up to 6 months, during which it would not be allowed to pay dividends or buy back shares. The alphabet soup goes on and on and on. There are a lot of acronyms out there. If you are interested, you can look that up and find out more and learn more about the acronyms that I mentioned already. It's a lot. And it's a good thing that there are glossaries out there so that people can go look those things up and just refresh their memory or learn more about them. That is all the time that we have for today. Thank you so much for joining me for the GSMC Financial News Podcast. If you are a fan of this podcast, please do follow us on social media, Facebook and Twitter, and give us a nice review, either written or 5-star. That would be amazing and would really help us out. Hope you are having a great week. Hope that you are staying home, helping to flatten that curve. I'll talk to you next time. Thanks. You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.